Welcome to the 74th edition of the Entrepreneur series. It's Monday, the 31st of March 2025, and today we'll take a look at the need for and development of a risk management process for African startups and SMEs. Before we get started, I would like to take a moment to welcome you to this channel. If you are visiting us for the first time, please subscribe, smash the like button, share this video and help us grow our family. If you have already subscribed, then show your support by liking the video and making a comment. Now let's jump in. Opening purview. The African continent is home to a rapidly growing startup ecosystem, with small and medium-sized enterprises, SMEs, playing a vital role in driving economic growth, employment, and innovation. According to the African Development Bank, AFDB, SMEs constitute over 90% of businesses and are responsible for up to 80% of jobs in Africa. Despite their significant contribution, SMEs are often faced with numerous risks, which can undermine their sustainability and growth prospects. In order to ensure their long-term success, it is crucial for African startups and SMEs to implement effective risk management processes that can identify, assess, and mitigate potential risks across various business environments. While the scale and complexity of operations may be smaller than large corporations, the risks they face are no less significant. In fact, due to their limited resources, SMEs often have less flexibility and resilience to absorb the impact of unmitigated risks. The importance of risk management for African SMEs. Risk management is the process of identifying, assessing, and prioritizing risks, followed by the application of resources to minimize or control the probability or impact of such risks. For African startups and SMEs, risk management is not a luxury, but a necessity. A significant number of African SMEs fail within the first few years of operation, with poor risk management practices contributing to their demise. In many cases, SMEs fail to anticipate or mitigate risks such as financial instability, operational inefficiencies, market volatility, regulatory changes, and cybersecurity threats, among others. For African startups and SMEs to compete in both local and global markets, a comprehensive risk management framework is essential. By identifying potential risks early on and implementing effective mitigation strategies, businesses can enhance their resilience, improve decision-making, and increase the likelihood of long-term success.
Key areas of risk management for SMEs. Risk management in SMEs is multifaceted and needs to consider various aspects of business operations. The following key areas are critical for effective risk management in African startups and SMEs. Financial risk management. Financial risk is one of the most prominent risks faced by startups and SMEs, especially in the context of Africa's volatile economic environment. SMEs often operate in economies that are prone to inflation, currency fluctuations, and fluctuating interest rates, all of which can severely impact business profitability and sustainability. Furthermore, access to finance is a significant challenge, as many African SMEs struggle to secure funding from banks and investors due to limited credit histories and collateral. For many SMEs, cash flow is one of the most critical aspects of survival. Risk management allows SMEs to identify and prepare for financial risks such as market fluctuations, currency changes, or rising costs. By proactively managing these risks, SMEs can avoid unexpected financial setbacks that could otherwise drain limited resources or even lead to bankruptcy. Risk identification. Cash flow problems due to poor financial management or market conditions. Limited access to financing and high borrowing costs. Currency and interest rate fluctuations affecting profitability. Non-compliance with tax and regulatory obligations. Risk mitigation strategies. Develop a robust financial management system to track cash flow and expenses. Diversify funding sources, including venture capital, angel investors, and microfinance institutions. Implement hedging strategies to mitigate currency risks. Maintain a good relationship with local authorities to ensure compliance with regulations. Operational risk management. Operational risks arise from internal processes, systems, and human resources. SMEs often face challenges related to inefficiencies, poor supply chain management, and the lack of standardized operational procedures. These issues can lead to delays, increased costs, and loss of business opportunities. Risk identification. Inefficient supply chain and logistics management. Lack of standard operating procedures. High employee turnover and lack of skilled labor. Dependence on a few suppliers or customers, creating business concentration risk. Risk mitigation strategies. Implement best practices in supply chain management and inventory control. Develop and document standardized processes for operational efficiency. Invest in employee training and retention programs. Diversify supplier and customer base to minimize concentration risk.
Market risk management. Market risk refers to the uncertainty and volatility in the business environment, including shifts in consumer demand, competition, and changes in industry trends. African SMEs, particularly those in emerging markets, often face challenges due to fluctuating demand, unpredictable market conditions, and competition from both local and international players. Risk identification. Shifts in consumer preferences and demand for products or services. Increased competition from local or international players. Economic downturns and market volatility affecting business performance. Changes in government policies and regulations that impact the market. Risk mitigation strategies. Conduct regular market research to understand consumer trends and adapt to changes. Develop a unique value proposition to differentiate from competitors. Build a strong brand and customer loyalty. Engage in scenario planning to anticipate potential market changes. Legal and regulatory risk management. The legal and regulatory environment in many African countries can be complex and dynamic, with frequent changes to tax laws, labor regulations, and business licensing requirements. SMEs often struggle to comply with these regulations, which can result in fines, penalties, or even the closure of the business. Risk identification. Changes in taxation and labor laws that affect business operations. Inadequate understanding of intellectual property laws and potential infringement. Challenges in obtaining necessary licenses and permits. Risk of legal disputes with customers, suppliers, or competitors. Risk mitigation strategies. Stay up to date with changes in local and international regulations affecting the business. Engage legal professionals to ensure compliance with labor laws, tax regulations, and intellectual property rights. Develop internal policies to manage legal disputes and reduce potential risks. Technological and cybersecurity risk management. Technological risks, including cybersecurity threats, are increasingly becoming a critical area of concern for African SMEs. Many businesses rely heavily on digital tools and platforms for marketing, sales, and communication. However, the risk of cyber attacks, data breaches, and system failures can have devastating consequences, particularly for startups with limited resources. Risk identification. Cyber attacks such as data breaches, hacking, and ransomware. Failure of critical technology infrastructure. Insufficient data protection and privacy practices. Inadequate IT skills and knowledge within the organization. Risk mitigation strategies. Implement strong cybersecurity measures, such as firewalls, encryption, and multi-factor authentication. Regularly back up data and invest in disaster recovery planning. Train employees on best practices for cybersecurity and data protection. Outsource IT support to specialized firms if necessary.
Environmental and social risk management. Environmental risks, such as natural disasters and climate change, as well as social risks, including community relations and employee welfare, are often overlooked by SMEs. However, these risks can have a significant impact on business continuity and reputation. Risk identification. Exposure to environmental risks such as floods, droughts, and other natural disasters. Negative social and environmental impacts of business operations, e.g., pollution, unethical labor practices. Stakeholder dissatisfaction and reputational damage. Risk mitigation strategies. Implement sustainable practices to minimize environmental impact. Develop a crisis management plan for natural disasters or social unrest. Engage with local communities and stakeholders to build positive relationships. Developing and measuring risk mitigation strategies. The development of a comprehensive risk mitigation strategy requires a systematic approach. It begins with the identification and assessment of potential risks, followed by the creation of action plans to reduce or manage these risks. Risk identification. The first step is to identify all potential risks, both external and internal, that could affect the business. This process involves conducting risk assessments and consultations with stakeholders, including employees, suppliers, and customers. Risk assessment. Once risks are identified, they must be assessed in terms of their likelihood and potential impact on the business. This involves ranking risks based on their severity and the probability of their occurrence. Mitigation plan. Based on the risk assessment, SMEs must develop a mitigation plan to address each identified risk. This plan outlines specific actions, timelines, and resources required to reduce or manage each risk. Monitoring and review. Risk management is an ongoing process, and businesses must continuously monitor and review the effectiveness of their risk mitigation strategies. This includes regular risk assessments, monitoring key risk indicators, KRIs, and adjusting strategies as necessary. Conclusion. The need for a comprehensive risk management process for African startups and SMEs cannot be overstated. By identifying and mitigating risks across key areas such as finance, operations, markets, legal and regulatory compliance, technology, and environmental and social factors, businesses can enhance their resilience and sustainability. Developing a tailored risk management framework that is flexible, proactive, and adaptable to changing circumstances will enable African SMEs to thrive in the face of uncertainty and create long-term value for their stakeholders. As Africa's business landscape continues to evolve, the role of risk management will be crucial in fostering innovation, attracting investment, and supporting economic development across the continent.
If you would like to know more, or wish to discuss brand sponsorship of any of our videos on entrepreneurship, please get in touch on any of the social media handles below. All our content is developed from real-life experiences in a professional and entrepreneurial journey that spans across 8 countries and 4 decades. Quote of the week: risk comes from not knowing what you're doing. Warren Buffett.